Hello, everyone. I'd like to welcome you today to our discussion of farm finances of farms in Southwest Minnesota. We're going to be taking a look at the profitability, solvency, and liquidity of farms in southern Minnesota using the database of the Southwest Farm Business Management Association. So we're going to take a look at 2022's results. What can the past tell us about the future? We've been through quite a roller coaster of incomes over the last several years. What can that past history tell us about what's coming ahead? Like I said, I'm Garen Paulson. I'm an extension educator with Ag Business Management with the University of Minnesota. Helping me at the association, I have field staff Tanya Knorr and Nick Sandegger, and Gretchen Thillen is our office support, and she and I are officed out of the Southwest Research and Outreach Center in Lamberton, Minnesota. So the database that we're going to be using today is the Southwest Farm Business Management Association. The association is a group of about 120 farms scattered throughout the counties you see highlighted here in blue. These farmers cooperate with the University of Minnesota. We help them with their record keeping. We do a thorough analysis of their operation, both on a whole farm basis, and then we break that profit and loss down to an enterprise level. And then in turn, in a completely confidential way, we use their data to do this research to see how farms are doing in southern Minnesota. And this data is from 2022. Just finished that up this winter, and now we're taking a look at the results. So 2022 in southern Minnesota was a year of extreme uncertainty, volatility, and risk. The Russian invasion of Ukraine here about a year ago really made some headwinds into some helped keep strong commodity prices very strong, which in turn led to high feed costs as well as high energy prices, which really impacted the profitability of farmers in the area. It was also a year of weather extremes. If you remember right, we went into 22 very dry, and there were portions of Southwest Minnesota that stayed very dry throughout the growing season and led to some real volatility in yields. You can't talk about 2022 without talking about inflationary pressure. Operating costs for our members of the association were up 18%. That's very significant. We saw this inflation coming even before 2022, and we'll talk a little bit more about that coming up here. You know, 22 was really a perfect storm. We had a rapid rise in global prices of commodities. You know, a series of events worked together to boost inflation in this latest cycle, including, you know, repercussions from the COVID-19 pandemic. A tremendous amount of government payments went out to farmers and to the general public. You know, the invasion of Ukraine was huge, and the shock to energy and food prices that resulted to that. This all, as we know, are impacting interest rates and leading to some tightening margins. So let's look at the southern Minnesota profitability then. In 2022, we had very strong profitability despite the global uncertainty, inflation, and drought. It was the fifth highest year when adjusting for inflation of net farm income. Let's talk a little bit about net farm income. Net farm income is kind of the bottom line profit or loss for a farm. It starts with your gross sales, subtracts your cash expenses, makes an adjustment for inventory change. As we all know, farmers have tremendous flexibility as to when they time income, when they time expenses. So they can really play with that cash farm income. But when we adjust for inventory change, then that really brings it into an accrual version of what really happened in 2022. And then we make an adjustment for depreciation of machinery and buildings. And that kind of leaves us with a bottom line profit or loss for our farms, the return to their labor and management. The average net farm income for the association, like I said, was a very strong $366,000. Median income was a little less at $271,000. So let's talk about those two. An average is, of course, where I added up all of the net farm incomes from all 111 farms in the association and divided by the number of farms. This gives you a real good indication of how farms in general, how the southern Minnesota economy, farm economy is doing. Median income, on the other hand, is where I line all of the net farm incomes up from highest to lowest, count down from the top, up from the bottom, until I come to the farm in the middle. And that was $271,000. This gives us a real good indication of how a typical farm is doing in southern Minnesota. And we'll talk more about the differences between those two. As always, there's a wide variation in profits. Areas of drought, livestock really impacted the profitability of our farmers. Fortunately, the last several years, our farmers have been able to improve their financial position. I think this is going to be important in preparation for the economic challenges that could possibly be on the horizon here in 2023 and beyond. So here is our gross farm income. Gross farm income is total sales, of course. Here we are in 2022, 1.4 million, a record if we just look at straight dollars, don't adjust for inflation. The different colors in the bar indicate what portion of gross farm income comes from crop sales here in green, livestock sales in black, government payments, in orange, and other income such as custom hire, those types of things here in blue. You can see over the years, crop and livestock income make up the lion's share of the income, although there are some years where government payments make up a very large portion of gross farm income. Fortunately, this year, government payments made up a very small portion of income, and most of these were some remaining programs from COVID relief programs going on here, but 1.4 million in gross sales. So here is our average and median net farm income. Bear with me, there's a lot going on here in these graphs, but the bars is average net farm income. So that kind of tells you how the industry is doing as a whole without adjusting for inflation. Here's that 366,000 I was talking about. So if we go back in history, here's 2002. If we look at the tops of the bars, we see some pretty nice steadily increasing profits here in the late 2000s. A little hiccup in 2009. It was a tough hog year, a very wet year for growing crops, if I remember right. But then followed that up by 3 very profitable years here in 10, 11, and 12. Very strong incomes. That was followed very quickly by a period of much tighter margins back here in the late 2010s until we get here to 2020, 21, and 22 with the strong commodity price increases we've seen and really some pretty good crops in the area in the last 3 years show another area of very strong incomes. The line in green is median income. Now remember, that's the number in the middle, probably more representative of a typical farm in southern Minnesota. It follows pretty much the same slope as our average. But what really stands out to me is that while most years average incomes are higher than median incomes, especially in the very profitable years, that's where we really see the difference between right here, between average income and median income. In the tighter margin years, these two numbers come together. So what that tells me is these highly profitable farms are able to figure out a way to stay profitable in the tight margin years, but position themselves to really take advantage of these big profitable years when they occur. So the red line on top is average net farm income. So that would be similar to the top of these bars, but adjusting for inflation. So if we look back here, while if we don't adjust for inflation, 2022 is probably the second best year in these last 20 for the association. It turns into about the 5th year when we adjust for inflation. These years back here become even higher yet. Looking forward, I mean, incomes don't stay strong forever. It certainly wouldn't be conceivable to see some tighter margins return to agriculture here for a few years. And like I said, most farms are in pretty good financial position to withhold that, handle that possibility. And we'll talk more about that in a little bit. So here is my high, average, and low net farm income. Here's my average line in the middle. The same as what we saw before, just at a little different scale here. So when I had my farms lined up from least profitable to most profitable to calculate a median, what I did was I took the average of the top 20% of the farms. So the very most profitable farms, that's what you see here in green. I also took the average of the very least profitable, the least 20%, that's here in yellow. If you notice, this low profitable group, profitability group, hangs right around zero most of the time. Even in the late 2010s here, became significantly less than zero. The only time this low profitability group sticks its head above water is during the very profitable time periods. So this shows us that 20% of our farms out here are really struggling. They need to really work at improving their management, improving their efficiencies to get up here, to get above zero, to be a relevant part of income. My high profitability group, man, some really strong incomes here, some really good profitable operations. And just like the difference between average and median, notice how in the highly profitable groups, or highly profitable years, this difference between high profit and low profit, look at how wide that is. Much tighter here in the little tighter margin years, and much wider again here. Like I said, these high profit farms have figured out a way to stay profitable in the tight margin years, but really take advantage of these highly profitable years. Rate of return on assets, rate of return on equity. This is where we compare our profitability to our asset base of our balance sheet of our farm operations. The line in black here is net return on assets. You see during that nice increasing profitable time period here, we see some very strong rate of return on assets. And again, here in 2020, 21, and 22, some very strong 10, 14, 9%, much tighter here in this low profit and low margin years here in the late 2010s. So that's rate of return on assets. This is where we divide it by the asset base. Rate of return on equity is in blue. This is where we divide it by your equity. Equity is assets minus liabilities, and the rest is the farm's investment they have in their operation. A little higher here. A real indicator of a strong year is where rate of return on equity is higher than rate of return on assets. That means that farm is able to make money even on borrowed money. Farmers call that leverage, but that doesn't always work. Look in these tight margin years. My black line is higher than the blue line, meaning they weren't able to earn enough to cover the borrowed money. Going to be interesting moving forward how this relationship maintains. It's going to be all key on the profitability that we see in our operations. Well, that's our profitability. Let's look at financial position, the balance sheet of the average farm in Southwest Minnesota. In 2022, we saw a 12% net worth growth. That's just fantastic. We don't see that very often. Very strong year. Farmers were able to build their balance sheets. Farms in the association have a very strong liquidity and solvency position as well. And that's going to be very important for the uncertain times that are ahead. Again, just like profitability, there's wide variation. I have many farms that their balance sheet is not in a strong position, and they need some proactive management to help strengthen that up so that they're able to withstand the tight margin times as well as take advantage of the high profit times. So here is the balance sheet of the average farm in Southwest Minnesota. If you add the green and blue lines together, that's total assets. So as you can see, the total asset base increased nicely during this nice profitable time period in the late 2000s, early 2010s. Leveled off, very little growth here in either assets. During the late 2010s, during that tight margin time, And we've seen some very nice improvement here in the early 2020s with some very good profitability. The line in green is the equity portion of the farm. You can see that's been increasing over time. If we look just at the green portion of it, it's a very similar picture to what the assets are doing. Farms showed nice equity improvement here in the late 2000s, leveled off, meaning they had just enough income to cover their family living and taxes. But then we saw some real nice improvement here in 2020 through 22. The blue portion is debt. As you can see, that has increased somewhat, but certainly not as much as our total asset base. So on average, our farms in the association are in pretty good shape in their debt to asset ratio. If we look at liquidity is a measurement of the day-to-day ability of a farm to meet its financial obligations. Probably the most common one is current ratio. Current ratio is current assets divided by current debt. So if you have a current ratio of 1, that means on your balance sheet you have the exact amount of current assets as you do current liabilities. Bankers like to see this number greater than 2. Here's 2. Here's my 2 line right going across here. And you can see during this good profitable time periods, farmers were able to build liquidity quite nicely, got up here to 3.25 in 2011. But then those tighter margins appeared, profitability went down, and look what happened to our current ratio. It went down right along with the profitability and even got below 2 here in 2017. And again, built right back up again during these good profitable times, right back up here to 3.25, down just a little bit in 2022. Looking ahead to 23 and 24, it's going to depend very much on profitability. Liquidity really is a symptom of profitability. If you have good profitability, in the long run, you're going to have good liquidity. But if your profitability is suspect, no artificial fixing of current ratio or working capital is going to fix that problem. This is really a symptom rather than a cause. Here's our debt to asset ratio, like I was talking about. As you can see, our debt to asset ratio has improved quite nicely over the years. Started here at about 45% debt back in 2002, about 31% here in 2022. And that's a very good, strong position to be in. Bankers like to see this at 30% or less. I always say if your debt to asset ratio gets over 50%, meaning your lenders own as much or more of your business as you do, that's when interest really gets to be expensive. Now, interest has been pretty reasonable the last few years. It hasn't been a huge expense for our farmers. But as rates start to climb and climb rapidly, we're going to start to see that number starting to become more and more important. And right on top of this graph is the average net worth. Again, it shows that same slope that we were talking about before, with some very good years here in 2020, 21, and 22. So let's talk about financial efficiency. Cost of production has been increasing and increasing rather rapidly. Inflation, supply challenges, profit demands all impact cost of production. As tighter margins reappear, which they could very easily here in the next few years, good cost structures pay off, and we'll talk more about that. But just like everything else, there are no cookie cutter farms. There's wide variation in the cost of production amongst our farmers. All farms need to work to improve financial efficiency. Small improvements really do add up. We'll talk about more of that in a little bit. 2022 turned out to be a pretty good year, 5th highest for the association, but our storm clouds gathering. Well, how can there be storm clouds with $7 corn and $16 beans we saw here at the beginning of the year? I maintain there were always storm clouds. Back in 2019, we were worried about trade wars. We're in a war with Mexico and China, our biggest countries that we export into. There was late planting back then, green snap, 2020, COVID-19. What a huge disruption to all of our lives, really. Especially painful for our livestock producers, having to worry about even getting their livestock to market to get them slaughtered when that time comes. 2021, Government payments were on everybody's mind. That was very important in 2019 and 20, the government payments from the COVID relief. Would they continue in 2021? And drought was starting to rear its ugly head there in 21, as well as input costs. I made this graph up back in 2019 and 2021. Input costs already then were starting to rise. 22, we're even more concerned. Fertilizer was starting to rise. Rents were coming up. 23, you're going to see we're going to have record costs per acre to put in our crop this spring. 24 are tight margins ahead. I don't know what the next storm cloud is that farms are going to have to look into. But what I do know is that efficient farms sleep the best, and we'll talk about that here in a little bit. But probably the easiest way for me to describe efficiency is to look at net farm income ratio. Net farm income ratio is the percentage of sales that a farmer keeps as profit. So the highest number is best. You want to keep as much of your sales as you can for profit. So bear with me here too. These lines kind of get tangled up once in a while, but that's kind of the point. So when I had those farms split apart, I took a look at the average net farm income ratio, bounces around here between 10 and 20% mostly, a little bit stronger here the last couple of years. Here's my low profit farms. That really bounces around here, 0. So anytime it's below 0 means a loss. They don't even have enough operating revenue to cover their operating expenses. Green is my high profit farms. Look at how steady this is compared to the others. These guys have kind of figured out a way to show a nice, steady, efficient profitability, often between 20 and 30%, even better here in 2022. So what happens in these few years here where my lines kind of get tangled up? You would think most years these differences in ratios line up the way you think they should. My high profit group has the best net farm income ratio, average in the middle, and my low profit groups are down here. But what happens in these years where they get all tangled up? Well, I've often kidded about how I think in 2010, 11, 12, you could have rented a gravel pit, paid the guy $200 an acre, and probably made money at it. It was all about volume in this time period. The more you had, the more you made. Same way a little bit here in 2021. But boy, what do I got here? 22 years worth of data. What can you say? 3, 4 of them. Volume was more important. Most years, efficiency was key to how these groups divided between the profitability levels, between the profitability groups. Efficient farms sleep the best at night. Here's our interest ratio. This is the percentage of gross revenues that goes to pay interest costs. Here you want least, of course. You want to pay as little interest as you can. Here's my high profit group down here in yellow, average, and red is my low profit group. Like I said, interest rates have been so low the last 2 years, down here, 3-4%, and even less here in 20 and 21 and 22. Interest rates have been very low. I've seen lots of operating loans in the 3-4% category back in those 20, 21, and 22 years. That will change now as the Fed tries to fight inflation by raising interests and raising them rather rapidly. I'm seeing operating loans coming in easy double of what they were last year. But interest is going to be a little slow to rear its ugly head for our farms because a lot of our farms were able to lock in their interest rates on their intermediate and long-term loans for 3 to 5 years. So it's going to take a while before those loans start to renew and make an interest rate adjustment. But the operating loans are going to happen real quickly here. But it's going to take a few years before the real pain from the interest increases is felt by our farmers, but it will come. And again, it depends heavily on your percentage in debt. If you're down below 30%, it's not going to be as painful. If it's 50% or more, it's going to be painful real quickly. So let's switch gears here just a little bit. In the past here, we've been talking about whole farm profitability. Let's break that down to the enterprise level. First, let's look at crop production. We saw for the most part trendline yields, especially in corn for 22, but here too, wide variation. There were pockets in southwest Minnesota that did not get good rains. And I've even seen some 50, 60 bushel corn, but there are also some areas in southwest Minnesota that had some very good corn. I've seen whole farm averages 220, 230, and literally everything in between. Soybean yields were disappointing for most folks in our group, even in the best areas. You know, soybeans just didn't quite yield out as high as the corn. We saw increased cost of production per bushel for both corn and soybeans, and our cost per acre were significantly higher in 2022 and headed higher for 23 and 24, and that's going to be a real concern, especially if our commodity prices start to ease up here from these high levels that they're at today. Soybean and corn were profitable thanks to yields and prices. It's very important that we manage costs for typical yields. We'll talk more about that in a little bit, but as we're building our plans, we can't always expect record-breaking yields. First, we'll talk about acres. Everybody wants to know how big our group is. That red line in the middle shows the acres over the last, well, this starts way back in 1996 here at about 600 acres. We got up to a peak here in 2016, 17, 18 at about 950 acres, and we're at about 880 acres here in 2022. So on average, a pretty good sized farm. A good portion of our farms also have livestock. So we're talking some pretty good sized farms here. Here's my high profit group. As you would expect, mostly the high profit group tended to have higher acres, my low profit group smaller. But these lines do get tangled up once in a while. More acres doesn't always equal more profit. Efficiency is very important. An important part of profitability of crop production in southern Minnesota is the cash prices received. And here is what we received in 2022, $14 for beans, right at the peak that we got back here in 2012 and 13. And right at $6 corn is the average sale price for our farms that sold corn in 2022, a little bit less than 2012-13, but not much. So very strong year, you know. Looking forward, will these prices stay up here at these levels, or will we come back down to normal here a little bit? So another important consideration of growing corn is yield. Here I've got my corn yields from the association back from 2000 to 2022 with a trend line drawn in here, and corn definitely is increasing in production each year. 2022, the average of everyone in the association was just short of 200 bushels, just a little bit better than 2021, about the same, right on trend line. You can get any closer to trend line than we've been the last couple of years. But when I talk about managing yields or costs for typical yields, our yields are below trend line just as often as they're above trend line. So when we're building our plans, making our purchasing decisions, we can't expect to be 20 bushels over trend line every year, year in and year out, because there are years like this where we're down below trend line, and just as many of them. But very strong year for growing corn, good crop considering how dry it was. Again, wide variation. Now let's talk about cost for growing corn. This is cost per acre starting here in 2002 going to 2022. Our total cost to grow an acre of corn was about $875 an acre, easily set a record. And it's also compared to back here to 2013, also about $100 an acre more than it was in 2021. So let's look at what made up these costs. Rent was $20 an acre more. Seed was a little more. Fertilizer was $46 an acre more. Machinery costs were up by $20. So you add those all together and you can see significantly higher for 2022. We will easily surpass $900 for the 2023 crop. And so let's take a look at the individual components then of growing corn. Here's our cash rent back here in 2000, just under $100 an acre. Here in the late 2000 teens, cash rent reacted very quickly to the increase in profitability of growing corn. Got to a peak here in 2050 and 2013. That's interesting because if you look at the market prices, the peak in market price of corn was actually here in 2012. So the peak happened a year after in cash rent. Cash rents did come down slightly during these tighter margin years here in the late 2000 teens, but they came down very slowly and they didn't come down very much. Reacted very quickly to the more profitable levels here in 2021 and 22. 22 being $20 higher than 21. And I'm with the guys coming in, it sounds like cash rents are going to be up at least another $20 for 2023. We're going to easily set a record here, well over $250 an acre. There's an old adage in the commodity business is that costs are quick to react to good profits, as you see here, much slower to react to tighter margins. And this graph just shows that out right to a T. You know, if we do get to tighter margins, I predict that we're going to slowly see cash rent come back down a little bit here in a few years, but it's going to take a while because, like I say, the peak in costs often happens a year or so after the peak in commodity price highs. This is interesting, machinery investment per acre at market value. This is where we take our farmers' investments in their machinery and divide by the number of acres that they farm. We spent a lot of time here in the late 2000s right at $300 an acre. Machinery investment reacted very quickly to these good profits. Farmers took those profits partially to avoid paying taxes, partially because there was good profits. They invested in new machinery. Gets to a peak here in 2014 at about $750 an acre. Levels off during these tighter margin years. Actually comes down a little bit here into 19 during the tightest of margins. But again, here we see that price increasing, or that value per acre increasing up to just short of $900 an acre here in 2022. Again, as farmers react to the good margins and to some extent to keep from paying taxes. I predict this number will continue to increase here a little bit as our farmers fight taxes from these good profitable years. And until we see some tighter margins, I don't see that coming back down again for a while. I also like this ratio or factor, machinery operating cost per acre. So this is where we add up the costs to run your equipment over an acre of ground. Fuel, repairs, custom hire, machinery depreciation, those types of things. So this way, a farmer who, let's say he hires someone to completely farm his farm, does all of the operations, plant, seed, fertilizer, spray, harvest, tillage. He can compare his costs to the guy who maybe owns all of his equipment and doesn't hire anyone to do anything. And in that group, I have some farms that have a fair amount of new machinery. Maybe you don't have quite as high a repair costs, but they have higher depreciation costs. And I've also got farmers that maybe have a much older line of equipment, maybe a little higher repairs, but less depreciation. So these guys can all compare, how am I doing? How is my operation compared to my peers? As you can see here too, these last couple of years, there have been some significant increases in machinery operating costs per acre. A big thing in 2022 was much higher fuel costs, but also machinery costs of newer equipment. $180 an acre to run equipment over an acre of ground in 2022. I see this going up even though fuel probably has calmed down a little bit from its highs in 2022, farmers continue to invest in new machinery, and repair costs are very significant now as well. So here is the per acre profitability of growing corn on cash rented acres. Here we are in 2022, a record at $450 an acre profit. Very strong year for farms in southern Minnesota. On average, good crops, good prices. But as we can see, corn is a very feast or famine. You know, here we are, $450 an acre, $350 to $400 during this good time period. But there are also some years down in here in the late teens where we showed some red ink here. We showed some losses, as well as here in the early 2000s. Very, very feast or famine kind of thing here on the profitability of growing corn on cash rented acres. So now let's take the cost of production and break it down to a per bushel basis. Now this includes some operator labor. So this is paying where the farmer pays himself a wage and builds into the cost of production. The red line is my average in 2022, about $4.75 to grow a bushel of corn. My green line is my high profit group, right at $4. And the yellow line is my low profitability group, about $5.75. Look at the significant difference between these groups. You know, you drive down the road, you look on one side of the road, then the other side of the road, the two cornfields look about the same, but boy, one of them, it could cost almost $6 to grow and the other just short of $4. And I think this difference between the high profit group and the low profit group is getting wider over time. Fairly close together here in the 2000s. A little wider here in this good profitable time, but boy, we're really starting to make there's some wide variation here. There's an old adage in the commodity business that cost of production and commodity market price often come together, and you'll see that in a little bit in the next slide or so. But new crop 2023 corn is right around just a little over $5. Look at here, we are $4.75, and I said I kind of figured cost of production would go up a little bit in 2023, maybe more towards $5 if we grow a trend line crop. It's almost as if the guys in Chicago know what's going on. Pretty common for those two numbers to come together. So if that's the case, if that's the market at work trying to make that happen, how do you make money growing corn? You have to be a little bit better than average. Maybe you have a green thumb, you can grow a good crop year in and year out. Maybe you're an expert at cost control, you can grow it for less. Maybe you're an expert marketer, something makes you better than average. Because otherwise, if you're an average producer, commodity price is going to come in there real close to there and not show a whole lot of profit. And here's what I'm talking about. Line in black is the price received by our farmers in the association over these years from 2002 to 2022. The line in red is the cost of production. So anytime that line in black is over the line of red, it shows good profitability, especially in here. In the last couple of years, there's some pretty good distance between the red and black line, but boy, there are some years here where the red line, the cost of production, is actually higher than the market price received, showing some losses, as well as back in here as well in the 2000s. You know, we're kind of figuring this cost of production is going to keep coming up here. Boy, it wouldn't be too hard for this market price to come down a little bit and come together and not show the good profits. So that's what we're seeing here in the past here. So let's talk about soybeans. Again, I've got the association's records here back from 2000. A trend line drawn in here as well. Most people wouldn't guess that the soybean trend line is going up as strong as it has been as well. It's easier to see it in the corn. I think it's because it's a higher bushel crop. You can see the difference easier. But in 2022, we were significantly below trend line yields here at about 53 bushels an acre. Trend line is more up here, 55, 56, somewhere in that neighborhood. But boy, just like corn, I mean, it's below trend line just as often as it is above trend line. We can't make our plans based on beans being 110 bushels better than trend line. Here is my soybean cost per acre chart, same as corn, from 2002 down to 2022. Cost about $650 to grow an acre of beans last year, significantly higher even than our next highest number here in 2013. Again, if you look at the components, cash rent is $20 a acre higher, seeds a little higher. Chemical costs are $25 an acre higher. You remember back to early 2022, there was concern about getting the chemicals in. So the prices were rising rapidly. And also, I think with the better prices that farmers were presented with, better commodity prices, they were maybe a little bit more apt to use a fungicide or take better care of their crop to ensure a good crop coming. Machinery costs, a full $22 an acre or more expensive. You add all those up, that's why you're seeing a 650. And again, looking forward, you know, I expect we're going to be very close to $700 to put this soybean crop in the ground this spring. It's going to take a lot of bushels to show some good profitability there. Here's my cost of production per bushel. Very similar graph to my corn graph. Here's my average. The average in 2022, it cost just a shade over $13 for my average group to grow a bushel of beans. My low profit group, boy, it took almost $17. You know, and some of this is in the drier areas where they didn't grow a very good crop. You know, the crop you grow is just as important as the cost it is to grow it. This green line is my high profit group. You're short of $11 to grow a bushel of beans. What a difference between these two. Again, I think new crop corn or beans, excuse me, are in that $12.50 range, right about where this cost of production is. It's almost as if they know what's going on there. Here too, you got to do something that makes you just a little bit better than average to show good profit per acre on growing beans. And here is that cost. Again, just very similar to the corn. Here's my price per bushel received from the farmers throughout the years. And the red line is their cost of production. Again, where the black line is over the red line, we're showing good profits, much tighter margins. Even the last 2 years have been much tighter margins for growing soybeans. There isn't much room here between the cost per bushel and the price received, leading to very tight margins. Here then is the profitability of growing soybeans on cash fronted acres, just short of $100 profit. So kind of an average year, as you can see, you know, beans are, if you'd average it out, I would guess that'd be about $100. But what you do notice, here's 200. You don't see those extremely profitable years of growing $400 an acre profit. But you also don't see as many negatives down here as you do with the corn. Beans are a much steadier crop. Year in and year out, you can probably figure on more like 100 bushels or $100 profit, excuse me. So let's talk about livestock production. Very tight margins for our livestock producers. High crop prices translate to higher feed costs. Matter of fact, I was afraid the margins were going to be much tighter than they actually turned out to be. Pretty hard to feed $7 corn and soybean meal made out of $15 beans to our livestock, but we had some pretty strong commodity livestock prices as well. The tight labor supply really impacts our livestock producers. They need livestock, they need labor to help load hogs and take care of hogs and take care of milking and such. And that labor supply was tight. Here too, inflation reared its ugly head as well. especially in the feed costs. Drought really impacted the pasture for our cow-calf producers, and we'll talk a little bit more about that in a minute. But drought seemed to impact our pastures worse than it did for our spring-seeded crops. What's important to realize on the profitability of livestock production, when we break that profit and loss between crops and livestock, we value the feed at opportunity cost. So if a farm grows its own corn, puts it into their cattle or hogs, we value that feed at what they could have sold the grain at. So even if an operation broke even here in 2022, they in a sense sold that corn through those livestock for a pretty good price. Like I said, the livestock sector held up well in face of higher feed costs. And the data now is from the entire state of Minnesota rather than just our group of 120 farms. Even though our farmers are more apt to have livestock than the typical farm, there's so many different types of livestock and then types of livestock within each species, types of production, that we needed to reach out to the entire state of Minnesota to get that data. So here is that opportunity cost for our producers that feed their own corn. We used just over $7 here in 2022. You can see that's one of the highest amounts ever. We calculate this opportunity cost by writing down the price of corn every Friday at a local elevator and dividing that out throughout the year. So in other words, if you'd have sold a bushel of corn at the local elevator every Friday, you would have got just over $7 for your corn. And that's what we used to charge our livestock operations. And that's essentially what they sold that corn for through their livestock. So here's our hog sector, farrow to finish and wean to finish hogs. This is profit per hundredweight of pork sold. Here's my zero line right here in the middle. You can see 2022 just showing a slight loss. Like I said, I was afraid that was going to be much worse with higher feed costs. You can see growing pork is pretty much plus 10 or minus 10 profitability kind of a thing, pretty tight margins. And you can kind of see the old hog cycle at work here. But in all actuality, our pork industry has gotten big enough. It's kind of taken that old hog cycle out of there. But like I said, very tight margins for growing pork this year, but better than what we thought it would be. Here's a very common enterprise for the members of our association, hog contractee per pig space. This is where the farmer producer owns the building, but contracts with the owner of hogs to grow that hog for him in his building. And the owner of the hog pays our farmer a fee, and the farmer gets to keep the manure, a very, very valuable source of fertilizer for our corn crops and bean crops, especially here in 2022. Profit was down just a little bit, right? You know, we're right at $6 in 2022 per pig space, down just a little bit from 21. Given the good, strong profitability, we saw a lot of producers doing some deferred maintenance, maybe working on the roofs of their barns, maybe on their hog slats. That might be part of the reason for the decrease in profitability. Another is there was some disease problems throughout in the hogs. Maybe they missed a turn or so where they weren't able to keep those buildings full. But all in all, very good source of income for our operations, as well as a really good source of fertilizer. Here are my cow-calf producers. They really struggled this year. This is profit per cow, $175, $180 loss per head. Like I said, the drought really impacted these folks. A lot of guys had to buy expensive hay just to get through summer, let alone to get through winter. And that was really painful. Feed costs are very important to our cow-calf producers. And just like corn in our hog and in our finishing enterprises, we charge opportunity costs for the hay that they make in their operations. We take a look at what they could have sold that hay for, and we value it accordingly. But tough year here in 2022 for our cow-calf producers with the tightening herd size we have in the United States. I'm hopeful that this turns around here in the next couple of years and returns some better profits for our producers. Beef finishing, this is where our farmers buy the feeder calf and finish it out to market weight. As you can see, we saw a nice little profit here. That's good to see. Beef prices were strong enough that to overcome our high input feed costs. So that's good to see. But as you can see, finishing beef is a very, very tight margin. Not a whole lot plus or minus from zero over here, and zero as often as above. That's why risk management is so crucial for our beef finishing group. So let's take a look at living expenses. Now, living expenses aren't an expense to profit, but this is what we use profit for, right? We use it to help raise our families. And it's a very important part of cost for our farm families. In 2022, farm profit exceeded family living. That's very good to see. That doesn't always happen. We'll talk about that. Total family living costs are increasing as you would expect. Non-farm income is important and becoming more and more so important. If you don't measure it, how can you manage it? There are a lot of our producers in southern Minnesota that probably don't keep track of their family living costs. And like I say, it's a major cost for our operations. And we really need to watch that. You know, I visit a lot with my young farmers to set up a budget. Farm incomes vary so from year to year, but it's important that we have a good handle of what's going on. Because if living costs aren't covered by farm and non-farm income, net worth is going to decrease, and that's a slow road to trouble if we just can't. We have to rob from our equity to pay our living expenses each year. Here are the household operating expenses over the years, just short of 70,000 here in 2022, up just a little bit from 21. That kind of surprised me. Down a little bit from the peak here in 10, 11, and 12. So family living includes things such as food, health insurance, medical costs, utilities, non-farm vehicle operating expenses, household supplies, education, recreation, those kind of things, kind of the day-to-day expenses for a farm family. What it does not include is income tax or non-farm capital purchases or investments of retirement accounts, those kind of things. So it's kind of the day-to-day operations of managing a house. So $70,000 is a pretty significant dollar amount that needs to be managed. The average family size, is just over 3 in the association. So this is always interesting to me. This is percent of gross farm income. So this is gross sales now, not net farm income, but gross. Look at how it ranges pretty much between 10 and 14%. I would guess that would average 12%. I guess that when it comes time for deciding how much we should spend on my family, I don't really think about, well, percentage of gross farm income, but this really is rather steady. Last year at the lower end of that range, about 11%. Here's percent of net farm income. This is what I'm talking about, where net farm income varies so from year to year, but family living costs continue on and on. So here's 100%. Here's my 100% line. That means the farm's spent 100% of its profit on family living. If it's above that, that means they spent more, meaning either non-farm income or equity is going to make up the difference. Here's where we like to be, less than 100%, meaning the farm made enough to cover family living and taxes and had some to set aside for the future. Here's 22 at about 48%, something like that. So very good year, good profit year. Non-farm income. This is interesting to me. Look at how pretty good steady increases here since about 2012 or 13. Pretty common for one, if not two spouses to have non-farm employment. Down pretty significantly from 2022, and that's interesting. So I dug into it, and the wages are about the same, interest income was about the same, all of that. But the big one that came down was non-farm business income. We've got a number of our farms that that have non-farm businesses, and they're down significantly from 21. I'm not sure 100% why, but even if this is an outlier, non-farm income definitely is increasing in importance for our farm families. Recent trends, now kind of bear with me on this. The line in maroon here is profit. We've seen this graph before, nice increasing profits, kind of a hiccup here in 2009, some very good years here, tighter margins and better years here than the last couple of years. This line in yellow is income tax paid. Notice how it kind of varies. It's much smoother. Farms are very good at averaging out income taxes. But what I want to point out is notice how the peak in taxes paid comes after the peak in net farm income. Notice that? And also, notice how these peaks kind of line up with some much tighter margins, lower profitability. So what I really work on with my producers is you need to keep some money from these good profit years to pay the taxes that are coming. Now, farmers can put off paying taxes, they can defer their income, they can prepay their expenses, but those taxes are eventually going to hit us. Same way here. Even if we do get some tighter margins, the profit from these good years are going to have to get worked through here. And it's important that we save some money to cover those taxes. This line in gray, that's our day-to-day operations of running a household plus income tax, plus let's say you bought a car or you put some money into a retirement account, something like that. So that's what that line is about. Well over $170,000. So it's a pretty significant number. That's why I say it's very important that we manage that number. Okay. So the key things we need to take away. Most farms in Southwest Minnesota are in very strong financial position. We just came through some very good years. And farms have been pretty good about building up that balance sheet. I think we can all see tighter margins ahead. Cost of production continues to increase. Commodity prices are uncertain. What's going to happen with that war between Russia and Ukraine? How about South America? Sounds like they got a really good bean crop coming. Maybe their corn crop might be a little uneven. Inflation. It took us a while to get into this inflation struggle, and it's going to take a while to get out of it. Unfortunately, about the only tool that the Fed has to fight inflation is interest rates. So a lot of our farmers that have higher debt to asset ratios are really going to start to feel that pain. I think it's more important now than ever to have a strong handle on your farm's finances. We have a saying around here, if you don't measure it, how can you manage it? So if you would like some help with understanding your farm's finances, that's what the association is all about. The association was formed back in the late 1930s to help farmers do a better job with record keeping and to better understand their farm finances. And all these years later, that's exactly what we do here. We offer farm financial analysis, confidential peer comparisons, that's benchmarking, where you can really see how am I doing compared to my neighbors. Benchmarking has been around for a long time. You go to any coffee shop towards the end of harvest, you know what that group of farmers is talking about. It's yields. But do you ever notice that the farmer with the best yields is often the last liar to say what his yield is? But with membership with the association, you know that we've gone through a thorough accuracy checks and in a very, very confidential way. There's no way you can tell my records from your records. You can compare yourself. How are you doing? Both on income and costs. So check out our website here at swfm.umn.edu to learn more about us. Give me a call. Here's my number. Email probably works the best here. That is At the association, we have two types of membership. Farm management, that's where we offer analysis, benchmarking, financial production and record keeping help, finance and goal review section. And then we have Farm Management Plus, where we add tax preparation and tax planning to farm management, where we actually complete your taxes for you. Again, if you don't measure it, how can you manage it? Thank you. If you have any questions or comments, here's my email address. Please shoot me an email if you have some ideas on topics you want for another year. Let me know. And also there's an evaluation form that you can fill out as you leave. That link is on the page you used to join this meeting. So again, thank you for your time, and I wish you a good planting season. I look out my window here, I'm still seeing some pretty good snowdrifts, but the good weather will come, and before you know it, we'll be out planting corn. And I wish you a profitable 2023. So thank you.